Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Suncor stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 54 billion market cap. They're trading at 42 Canadian dollars a share, and they have 1.3 billion shares outstanding. Since they report their financials in Canadian dollars, we're going to look at the ticker that trades on the TSX. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had a really rough year in 2020. Oil prices crashed. Remember in April 2020 when oil prices became negative? So you can see how low their revenue is that year, which is why they have negative free cash flow and a big loss. But things improved dramatically in 2021. 7.2 billion of free cash flow, 10.5 billion in 2020. I think that's their best year ever. It came down in the trailing 12 months to 6.2 billion, but still a pretty healthy profit. Net income is the profit or loss on the income statement. It's revenue minus expenses. That has a similar trend, a big negative in 2020, then big profits after that, peaking in 2022 at 9.1 billion, a healthy 8.2 billion in the trailing 12 months. Revenue is a sales for the company, and you can see that more than doubles from 25 billion to 54 billion. It was highest in 2022 at 58 billion. It's not that much guesswork with this company. If oil prices are high, at least above $60 a barrel, they're gonna make money. When it's $80, $90 a barrel, they're going to knock it out of the park. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows, past year 4, that's 83 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of 78 billion Canadian dollars. We divide that by 1.3 billion shares. And we get a calculated stock price of $61. They're trading at $42, so they're trading at a 31% discount. It's a pretty solid buy according to the model. And you can see their free cash flow estimates aren't that aggressive. They're all lower than 2021 and 2022. There are 10 companies in the same industry as Suncor, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. So this entire chart is in US dollars. That's why these numbers are slightly different than my Excel file. My Excel file is in Canadian dollars. Companies in the integrated oil and gas industry operate in all stages of the oil and gas process. Downstream, midstream, and upstream. Well, I guess it's mainly downstream and upstream. Midstream is slightly different. But upstream is when they pull the oil from the ground, the very first part of the oil and production process. Downstream is the refining process, right before it gets to you, the end user. So if you're in this industry, you have to spend a lot on CapEx. The median is 2.7 billion, average is 7.3 billion. Exxon spends the most, over 21 billion. This company, 2.1 billion. Everybody has a debt to equity ratio below 1. And the reason it's so good is because all these companies are cash cows. Lots of cash in this industry, the oil industry. They have a 0.4 debt to equity ratio, which is the average and median. For every dollar of equity, they have 40 cents of debt. Pretty much all these companies pay really good dividends, and it's consistent dividends. Suncor is really high at 5.1%. Total Energies, the French company, 6.3%. Free cash flow, 4.6 billion, higher than the median, lower than the average. Exxon is highest at 38 billion. This company ranks 5th in market cap. Exxon and Chevron, the giant American companies. When I was in high school, Exxon was the largest company in the world. I want to say 700 billion market cap, if I can remember right, but don't quote me on that. I'm referring to 25 years ago when I was in high school. And this company has great price multiples, all better than the median. Really impressive numbers. They traded 8.7 times free cash flow. Look at BP, the giant British company. They have amazing price multiples. Seems like a really good deal. Suncor's revenue is almost exactly the median. Look at BP. They have the most revenue relative to their market cap. Their price to sales is 0.5. That means their revenue is double their market cap. Actually, it's a little more than double. So if we went out another decimal on their price of sales, it would be 0.46, 0.47, something like that. And Suncor's 5-year annual revenue growth rate is 5%, which ironically is the same as the top three. BP is detracting, -5%. Cenovus is killing it at positive 19%. I'm not too familiar with this bottom company, Stabilis. I don't know if I'm saying that right. They're at 44%. And this is an interesting chart from Yahoo Finance. This is Suncor's stock price, the blue line, the past 5 years, and this is the price of Brent crude the past 5 years. So their stock price should track the price of Brent crude because they sell a commodity and their profits, their revenue is highly dependent on the price of oil. If oil shoots way up, their stock will go up, as you can see. And if oil prices crash, like they did in April 2020, so will their stock price. It doesn't move exact, but over time, they pretty much track each other, as you can see here. Let's take a look at their third quarter report to shareholders. All financials are in Canadian dollars, like I mentioned earlier in the video. Adjusted funds from operations, $3.6 billion. That's just for the quarter. And adjusted operating earnings, $2 billion. When it says adjusted, they usually strip out non-cash items or one-off items. A common expense they take out is stock-based compensation. They returned nearly $1 billion to shareholders. Most of that was through dividends, $676 million, and then buybacks, $300 million. Total upstream production, 690,500 barrels of oil equivalent per day. It's a lot of oil. Upstream is the very beginning of the oil and production process. It's the extraction of the oil from the ground. The upstream part is the most difficult. It's also the most lucrative because it's really expensive to extract the oil. You need a lot of expertise and infrastructure. There's drilling, excavating, lots of man hours. And you may do all that work and not even make any money. Because say for instance, it costs you $50 to pull a barrel of oil. And that includes a lot of things. Getting your men there, setting up the drills, doing all the analysis beforehand, moving the oil from one location to another, refining the product. Let's just say once you do all the work, a barrel of oil costs you roughly $50 on average from this particular location. Then oil prices only need to be above $50, which isn't that high. What if there are a lot of issues? A lot of things go wrong. The oil rig breaks down, taxes are a lot higher than you thought, there's not as much oil at a particular location than you thought there would be, and it ends up costing you $8 a barrel. Well, if oil price is only $70, you lost $10 per barrel. But if you do it right, you could be a massive company like this, or Exxon. So the first step of the oil and production process is the upstream part, extracting the oil from the ground. Then the midstream part, storing or transporting the oil. Most oil is transported through pipeline, some through vessel. And then refining is the downstream part, the last part of the oil and production process. You convert the oil, the raw product, into something useful, like jet fuel or gasoline. They're almost at 100% in their refinery operation, 99%. Refining is a downstream part. Refining is really important because we need that commodity to heat our homes, for electricity, all our transportation. Well, not all. People use EV cars, but the vast majority of our transportation is with oil. Planes, buses, railroads, almost 100% of that transportation is oil. Cars, I don't know, maybe 90% of cars use oil. And I know it's getting more and more EV usage, but oil is here forever. And I could say with 100% certainty for the rest of our natural lives. They give some financial highlights. Their net profit for the most recent quarter is $1.5 billion. Last quarter, $1.9 billion. Last year, in the third quarter of 2022, they had a loss of $600 million. So their EPS is $1.19, lower than last quarter. But even though they had a net loss, look at their funds from operations last year, $4.5 billion, which is higher than the current quarter, $3.6 billion, and a lot higher than last quarter of $2.7 billion. Because net earnings is the income statement, and the income statement has lots of non-cash items like asset impairments, which drastically reduce your profit or loss. So that's why looking at funds from operations or cash flow is a much better indicator of how the company's doing. It's not the only indicator. These numbers can be influenced as well. So you have to look at the whole picture. But if you only focus on one number, I would say operating cash flow as opposed to net income. That tends to be much more reliable. They spend lots in CapEx, about $1.5 billion a quarter. Free funds flow. I guess that's free cash flow. I never saw that term used, free funds flow. 2.1 billion. That is free cash flow because 3.6 billion operating cash flow minus CapEx. That's a calculation for free cash flow. Operating cash flow minus CapEx, which equals their free funds flow or free cash flow. Dividends per share, 52 cents, same as last quarter. Share repurchases, 23 cents per share. When they give you a dividend, they're giving you cash, 52 cents of cash per share. When they buy back stock, they're giving you 23 cents in a higher stock price. So if you do sell the stock, you'll get 23 cents more than if they didn't buy this back. Their net debt is 13 billion. That's debt minus cash. That is lower than last quarter and last year. Look at their refinery utilization. It's 99%. It was 85% last quarter, 100% last year. Very efficient operation. If you're interested to understand how they come up with adjusted operating earnings, here's how. You start with your net income, 1.5 billion, and then they add or subtract some items. These items are from the income statement that they feel don't paint a good picture, so they strip them out. They add back 256 million of unrealized foreign exchange losses. If it's in parentheses, it would be a gain. 13 million of unrealized losses on risk management activities. And if you really want to know more about this, if you're not sure what this means, leave a comment and we could talk further about it. 253 million of derecognition and asset impairments. Remember, I was talking about asset impairments. They had 3.4 billion of asset impairments in the third quarter of 2022. That's why they had a net loss, which is really common with companies that have lots of fixed assets. They pass through many impairments, sometimes really big ones like this. Goodwill impairment is another common one that brings down a company's net income. So if a company does lots of acquisitions, then they tend to pass through lots of goodwill impairments. And then a negative 86 million. This is an income tax recovery. This means they pass through a gain on the income statement, but they're stripping it out. They're subtracting it from this section to come up with the adjusted earnings. They're adjusting the earnings of 1.5 billion. So they're saying 2 billion of earnings is what we feel it should be because we're adjusting it. This 1.5 billion is a GAAP number, generally accepted accounting principles. This is non-GAAP. It's their own number they made up. Total oil sands bitumen production, 787 million of barrels per day. That is down from last quarter. Synthetic crude oil and diesel production, 489 million barrels. Their total upstream production, 691 million barrels. But not all that oil they refined. They refined 460 million because they pull it, refine it, and then sell it. Sometimes they just pull it, then sell it, and another company refines it. Let's just say, for example, they sell the raw oil to BP, and BP has refining facilities, so they can refine it themselves. Here's a big acquisition. They reached an agreement to acquire Total Energies Canada. Just a Canadian operation of Total Energies. Total Energies is a really big company. They're a French company. And that entity holds a 31% working interest in Fort Hills. And they're paying 1.5 billion, so it's not cheap. They have to go through the regulatory loopholes, so it could take several months or several years to complete these acquisitions. Here's a pretty neat slide. Their last 8 quarters. Total upstream production is lowest this quarter, under 700 million. If we look at it in September 2022, it was 720 million. I think they mentioned some divestments on the first page of the presentation, so they may have sold off some of their business units. Gross revenue 14 billion, which is higher than the prior 2 quarters, and they have lower production because oil prices are a big factor. They could produce less oil and still have a lot higher revenue because revenue is oil production times the price of oil. That gives you a pretty good gauge of their revenue. June 30th, 2022, almost $18 billion of revenue. I'm sure oil prices are really high that quarter. So their net earnings, $1.5 billion. $4 billion was the highest in the second quarter of 2022. EPS $1.19. It was highest at $2.84. Cash flow smooths things out because it takes out the non-cash items, those big impairments. So you can see their highest cash flow, $4.4 billion, was when they had a net loss. So they actually did really well that quarter because you really need to ignore those big impairments. They did really well this quarter, $4.2 billion. They had one of their best quarters in terms of cash flow per share, $3.22, a little lower than $3.26, but a lot higher than last quarter, about 50% higher. ROCE, return on capital employed, 15.8%. That's for the trailing 12 months. The calculation for that is EBIT. That's a numerator, earnings before interest and taxes. And the denominator, the bottom of the equation, is assets minus current liabilities. And this is a stock price on the TSX. In the fourth quarter of 2021, it was under $32. It's at its highest point in the past 2 years, 47. And the New York Stock Exchange, the low was 25, the high was 34 in the past 2 years. Let's take a look at the stock on Simply Wall Street. Its last price was 42 Canadian dollars, 54 billion market cap. It's down 6% in the past week, up 3% in the past year. Let's learn a little more about the company. They operate as an integrated energy company in Canada and around the world. They operate through oil sands. Canada has the largest amount of oil sands in the world, and you can find a ton of oil sands in Alberta and Saskatchewan. They also do exploration and production, refining and marketing. The oil sands segment explores, develops, and produces bitumen, synthetic crude oil, and related products. This segment also engages in syncrude oil sands mining and upgrading operations, marketing, supply, transportation, and risk management of crude oil, natural gas, power, and byproducts. The exploration and production segment is involved in offshore operations in the east coast of Canada. The refining and marketing segment refines crude oil and petrochemical products, markets, transports, and manages refined and petrochemical products and other purchased products through the retail and wholesale networks. This segment is also involved in trading of crude oil, natural gas, and power. The company was formerly known as Suncor and changed its name to Suncor Energy in 1997. They were originally founded in 1917 and headquartered in Calgary, Alberta, Canada. Here's their stock price since 1993. It reached its peak in 2008 at $71. Then there was a big crash down to the low 20s in 2008. Over the next decade, it ran up to 54. And then when COVID hit and that big oil crash, it came down again to below 20. And it has been coming up a lot since then. It did break through 50, but now it's trading in the 40s. Simply Wall Street's valuation is 57. They say the stock is 27% undervalued. 19 analysts priced this stock at $54. They also say it's undervalued. Their revenue back in 2012 was $38 billion. It was fairly steady for a few years, down to $25 billion in 2016, up to $39 billion in 2018. Then oil came down, so their revenue came down to $25 billion. Their peak was $58 billion in 2022. It is down a little bit since then at $50 billion. And their revenue forecast over the next few years is down. It's down to $47 billion by 2025. And that forecast is by 3 analysts. You can see they always keep a good amount of debt on their balance sheet. In 2012, it was $10 billion. It got up to almost $20 billion in 2020. They are paying down their debt. It's down to $12 billion again. But they have a lot of equity. Their equity is always higher than their debt. As you can see here, the blue line is their equity. And they don't really keep much cash on their balance sheet. They deploy their cash. They give it back to their investors for dividends, and they use it for capex spend. This purple line is their annual dividend. And you could see it went up from 92 cents in 2014 to $1.86 in 2020. They cut their dividend to 84 cents, and they kept it that way for several quarters. Then at the end of 2021, they brought it back up to $1.68, and the forecast is for $2.31 by 2025. And this blue line is their yield. You can see their yield follows their dividend. So it looks like they cut their dividend because their stock price came down a lot. Because their yield did get pretty high, up to 7.5% in March 2020. That's because the stock price came down so much. Not much insider activity, one buy for 10,000 shares. 65% of the company is held by institutions, 35% by the general public. Sanders Capital is the biggest shareholder at 4.3%. They own a lot of Meta. I think they're based in Florida. Then Vanguard at 3.88%, RBC, Royal Bank of Canada, BMO, Bank of Montreal, another Canadian company, Scotia Asset Management. It's not surprising seeing Canadian companies own this company because Suncor is one of the bigger Canadian companies that trades. CIBC owns 1% of the company. Toronto Dominion Bank, BlackRock. Their employee count was 14,000 in 2012. It's currently 16,600. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Toronto Stock Exchange, and Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.